morning, everybody. Can you guys hear me okay? Give me a Y or an N. Or I guess you can't put an N because you wouldn't be hearing what I'm asking you. So just put a Y if you can hear what I'm saying right now to you. Should be okay. Looks like everything is good. Yes, yes, good. Great. I see that some of you are in the room already. Good time for a webinar. Yeah, I think 9 a.m. works pretty well for me as well. How's everybody doing? I hope everybody's well. I'm ready to get down to business. I got my coffee here. 2 p.m. London. Nice. Hey, Dan. So today we're going to be doing a classroom session. Because we have all the rules. The rules are in the on the site within the different levels, depending on what level of access you have. You have different lessons that you have available to you. And Marvin, I'm at work. Nice. Hope your boss doesn't see what you're up to. Depending on what levels you have access to, we're going to be doing classroom sessions because I think it's important. You know, we have the lessons for you to watch so that you get the concepts. I think it's also important to review the lessons and look at current charts and apply the lessons to the current charts so that you have a really good understanding of what it is that we need to do. Okay, so this session is going to be at the very core of all the lessons, the finding of the institutional supply and demand zones. So this is level 1. This is the very first lesson that you'll need to understand to be able to understand supply and demand and how it works and how the institutions get in and where they get in and why they're getting in, where they're getting in, and all that stuff, okay? But before we start this session, I wanted to just explain something a little bit more. So those members that have been with me for some time, you more likely than not have access to level 2 lessons. And I'm in the process of working on level 3 lessons right now. And new members, we have a new graduated learning system that I've put into place, and new members coming in here will only be given access to level 1. And there's a couple reasons why I'm doing it this way. Okay, number 1 is I'm interested in sharing everything I've learned about the markets and continue to learn about the markets with people who are interested in really learning this craft and becoming professional at it. Okay, I'm not here to work my butt off to learn you know, some really good information about the markets and how to trade the markets just to give it to anybody. Okay, I'm not here to offer my hard work to anybody who just wants to learn it for the sake of knowing it. And I see a lot of that happening, okay? And it's just human nature. I mean, people pick up a book and instead of reading the whole book and enjoying the journey and really appreciating the book for what it's worth, a lot of people will read a mystery novel and they'll pick it up and read the first chapter and then go to the last chapter and see who committed the crime and all that and say, okay, good, now I got the answer, now let's move on. And trading, if you apply that same type of thinking to trading, you will never become successful in trading. Okay, that's one thing that's for sure. And I see a lot of that in this business. And I'm not interested in wasting my time with people who just want to watch all the video lessons so that they can say, aha, now I know all the good stuff. Okay, I'm not interested in sharing my information about the markets to people who just want to know. So that's one of the reasons why I've created this graduated learning system, because you know, when you sign up for university and it's a 3-year program, You know, when you go into school for the first day, you're not given course material for all 3 years. And there's a very specific reason why, right? Because you won't, if you're not understanding the course material from year one, how are you going to have any understanding of the course material from year three? You're not going to. And what's going to happen is, if you're given all the course material now, you're going to go through all of it. You're going to be completely overwhelmed with the amount of information, and you're just not going to do anything with it. Okay? There's not going to be any appreciation for the information, and you're going to be completely lost because you're not going to know where to start. And my goal in providing this education for traders, I have a very specific goal, and I'm looking to transform people into professional traders. All right, that's what I want to do. I want to build a reputation for being able to transform traders into professional traders who are trading consistently, and potentially even getting to the point where they are managing money on others' behalf. Because let's face it, I mean, the goal of trading is to become consistent at doing this profession, in your consistent in your analysis, in the way, in the manner that you take your trades, in your routine, and you know, hopefully eventually getting it to the point where, you know, maybe for some of you, you want to make this a full-time career, and you can make this a full-time career, but you have to take it seriously, and you have to take it step by step. I mean, this is a learning process, and it takes a lot of time to do that, to go through all those. So I don't want to do a disservice to anybody by just overwhelming you with a bunch of lessons, because all this stuff took me a long time to put together, and I'm still working on it. Okay, I'm still collecting data and doing tests and working on concepts that I'm just starting to understand now, that I'm realizing that I haven't realized over the last few years. Okay, but all the stuff that I have been releasing that I have already released to everybody, especially for level 2, are concepts and ideas that I've worked out on my own through countless hours of hard work. Okay, so it's taken me a long time to understand these concepts, and I don't think anybody is going to just sign up and within 3 months watch all the video lessons and just understand it. It's just not going to happen that way. So the graduated system is for 2 reasons. One, to help you, to keep you on track, to help guide you through this road of truly understanding the markets and finding a good routine that you can follow every single day, and then you being able to spot the institutional trade signals, and you being able to understand what's high probability and what's not high probability, and really understanding why it is what it is. Okay. And number 2, I'm not looking for people who are just wanting to sign up to watch all the lessons and then say, oh, thank you very much, that was fun, now let's move on to somewhere else. I'm not interested in sharing my information with those type of people. Okay. So now that we've got that matter out, let's get down to the classroom session. Okay. So we're doing a classroom session because, once again, it's important to it's important to watch the video lessons and watch them as many times as possible so that you get the concepts. But then I think it's important to have a session where we will re-examine what was taught in those lessons and apply them to real world circumstances that are happening right now. Okay. Now, a few of you have sent me some questions in regards to supply and demand. And so let me see, I wrote back a message. Steve, are you here, sir? Where are you? I don't see Steve. Steve, are you here, buddy? Let's see if I can find you. Glenn, George, Jasper, Kevin, Marvin, Sergey. I don't see Steve in here yet. Okay, so before we begin, does anybody have any questions regarding supply and demand that are, you know, the basic questions? How we find them, what it is, why it works, the differences between an imbalance and supply zone or demand zone, anything like that? Any specific questions that you want to ask? I'll take a sip of my coffee and I'll wait for your responses. You're sneaking and watching this. If I disconnect, I'll catch up. Okay, good stuff, Marvin. Coffee, good call. All right. So no questions? So you guys completely understand that, well, there must be a reason why you're here for this session, right? George, ask away. There must be a reason why you're here for this session. Maybe you just want to review to see if you are on the ball with your understanding of supply and demand, or it's something. You would just love a review. Good, reviews are good. I do. It's regarding ambiguous zones. I want to recap on drawing zones correctly. Okay. George, regarding ambiguous zones, when you trying to find the chart that I screenshotted. Okay. While you find that chart that you screenshotted, I'm going to start. Okay, so we know that what we're looking for is we're looking for imbalances in the markets that are large imbalances, because the whole idea about supply and demand is we are trying to trade alongside the institutions, okay? Because at the end of the day, we have determined that the only thing that moves the markets are the institutions, period. Hands down, nothing else moves the market except for the institutions, okay? The institutions have created a market, the largest market in the world, trillions of dollars traded every single day, and they've created a market that is basically the whole purpose of the markets. Well, they used to have a different purpose before retail traders got access to them. But now the whole purpose of the markets is to transfer wealth from your pockets into the pockets of the banks. Okay? Obviously, there's other reasons for corporations to transfer money from one currency to another, and all sorts of other reasons why the Forex market exists. But the whole dynamic behind why the market exists today, since retail has been given access to trade it, is solely for the purpose of transferring wealth from your pockets to their pockets. Okay? And so when you go to the library or to the bookstore and you buy books on trading the markets, you will find tons of information about different systems that teach you how to trade the markets. And I think about 95% of them are teaching you how to trade support and resistance, okay? And support and resistance is basically areas where price came down, stopped, and reversed from, okay? And then we draw a line, and then when price comes back up, these are areas of resistance, okay? And so what you'll see is a lot of trend lines, sideways, upwards, and then you end up having charts that look like a mess. Okay, some people have honed in their very specific style, and they draw their trend lines in a certain way, and they figure out a way that works for them, and that's great. Okay, that's great. But what I have been able to determine through the help of mentors and through a lot of my own work is that, in a world where we hear a lot about algorithms and algorithmic trading and all sorts of stuff like that, what I've been able to determine, and this is not just, this was an idea that I had in my head at one point. I mean, my mentors had mentioned how the markets were heavily manipulated. But then I started, watching some documentaries on algorithms and how they work and why they exist. And what I've been able to determine is, the banks, the biggest banks in the world, the big players in the markets who are trading, think about it. Okay, just think about this idea. If you are a trader for one of the largest banks in the world, and you know that you're one of the traders, and you know that your orders are what are moving the markets, okay, because you're placing such massive positions, you know that when you buy down here, you're accumulating a massive position and you have intentions to purchase more here because your goal is to ride it out until you get to this area up here. If you know that, you are the one that's moving the market alongside your other buddies who work for the largest institutions in the world. Ask yourself this question. Would you need an algorithm to help you to determine when to buy and when to sell? Okay, just think about that. Would you need an algorithm to help determine or to automatically trade on your behalf? To determine the best entries and the best exits? If you are the one making the market, why do you need an algorithm to determine for you when you want to get in, when you want to get out? The thing is, you don't need it. Okay, think about this. You don't need that. So then why do they have algorithms? Okay, well, think about it this way. If you wanted to buy here, okay, in the market, and this is the euro. Let's say this is the euro US dollar, okay? Euro US dollar. If you wanted to buy here and eventually get out here at the top here, when you're filling in billions of dollars of buy orders, what do you need there? I mean, you're going to buy it from who? Who are you going to buy it from? The other big banks who are trying to do the same thing as you? Well, you know, there are a lot of hedge funds out there. There are a lot of institutions. I mean, heck, there are so many out there that are not in the loop, okay? Only a small amount of banks are in the loop. And you know they're in the loop because they're all doing the same thing, all right? So when you're buying here, who are you buying it from, okay? If you have 7, 8, 9 of the largest institutions who take up more than 50% of the market, okay? If you're one of that group and you're buying, you don't want to buy it from your buddy, okay? Because he's trying to get in here with you and ride it to up here as well with you. So you're not going to be buying it from him. So who are you going to be buying it from? You're going to be buying it from somebody who is not in the loop, period. Okay, that's how it works. You're going to be buying it from you, from me, from a hedge fund in New York, from a hedge fund in the UK, from a hedge fund in Japan, from an institutional trader somewhere who's not in the loop. That's who you're trying to buy it from. Those that have been trained through 2 different sources, fundamental traders and technical traders. Technical traders who have been taught the way that is taught in the books that you find, in the courses that you find, in the classes that you find, in the abundance of material online that teaches you how to trade, okay? So if you're a massive institution and you're looking to buy here on the euro and you want to get out here, then what you need here is you need people to sell you positions, okay? And if you're talking about spot Forex, you're looking for people to sell you euros right here. So who in their right mind would sell you euros at a low price if they thought that price was going to go up here? Nobody would, okay? That's the bottom line. Nobody would. So how are you going to make people sell you the euro when you need to buy it here? How are you going to make people do that? Couple ways. One, you can have a big piece of news be released that you know, the rate drops on the euro, or unemployment is not good, or Trump comes out and says something against the European Union, or whatever. There's a whole list of different things that can happen. A tweet comes out, somebody resigns, an election doesn't go through the way that the public wanted. I mean, you could pick from it, okay? There's just so many different things that will cause people to sell the euro when price is down here, okay? One of those ways is through technical analysis, okay? So if we have price coming down like this, okay, And we have a trend line coming down like that. Okay. The textbooks say that when you have, let's say there's a line here of support right here that you've drawn across, right? And price comes down, hits support, comes up, makes a lower low, breaks through support. Now trend line's connected. Maybe it even goes back even further. Price comes up. Now who's selling? Everybody who understands support and resistance and trend lines. And price comes up here, and guess what? European Union, European rate has dropped. Or they've released news that they're going to be extending quantitative easing. Okay, and everybody on CNN and on the news have been saying, oh, if quantitative easing continues, this is not going to be good for the euro. You know, all that is coming out in the news as price is coming up here. Okay, it comes up here and then boom. So when you have multiple scenarios like this playing out on multiple currency pairs, on multiple time frames, who's keeping track of all this? Okay, who's keeping track of all this? How is a World Bank or a major financial institutions supposed to keep track of when all these trend lines are being hit, when all this news is coming out, giving the signal for the banks to get into their long position? What's helping them? Algorithms. Okay, so think of it this way. Wouldn't it be smart if you could take all the information that is taught about fundamental analysis, all the information that is taught about regular technical analysis, support and resistance, trend lines, and you program that all into an algorithm, not to give you a signal to follow those instructions and buy and sell based on what those textbooks tell you, but to do the exact opposite so that you can open up a position? Does this make sense, ladies and gentlemen? Okay, think about that. Does that not make sense? When you're looking to buy something, you need a massive amount of people to sell it to you, right? So wouldn't you program an algorithm not to give you the buy signal based on what those textbooks tell you, but to give you the buy signal based on those textbooks telling you to sell, right? Boom, there you go. That is how the markets work, period. And I've been studying these markets long enough and hard enough to see that there is no coincidences, okay? This happens over and over and over again. I can't tell you how many times I've seen this play out where, you know, price comes into a demand zone and all of a sudden bad news comes out about the euro. And I'm like, how funny is that? Once again, we have another scenario where price is in a demand zone and some bad news came out. And look, everybody's now going to start selling the euro. It's exactly what the banks want to do. Okay, so this is how the markets work. So when you talk about algorithmic trading, I mean, just the other day I was talking to somebody and they're like, oh, how's trading? And I said, oh, good. Do the algos make it less, do the algos make it more difficult for you to trade? Because I hear, you know, all these algos and stuff, they're like so fast and they're opening up orders right before you. That makes no difference, okay? That doesn't make any difference. The algos and getting into trades before you, that's basically trying to take you and your focus off of the real reason why algos exist. Okay, algos exist to find where the retail traders are willing to sell so that they can buy. So the whole concept of supply and demand is not following regular technical analysis and fundamental analysis, because those are just going to, if you don't use them correctly, lead you down the trap, okay? Lead you down the pathway to get trapped, all right? So then what does work in trading? Well, if we know that the institutions are the ones that are moving the markets, then all we want to do is follow what the institutions are doing. We want to follow when they're buying and when they're selling. And we also have to understand how the markets work in terms of, you know, trends, and how do I know that they're buying here to go to here? Okay, and that's what market dynamics is all about. Understanding, when this is going to be buying here, to buy here, to move it up here, or if they're only buying here to get out here. Okay, there's a way to know that. Okay, so we're only interested in finding institutional buying and selling. All right, so then we have this concept of zones and imbalances. Okay, it's an important thing to understand the difference between a zone and an imbalance. So if you have a candle like this, and you have a 50% candle here like this, okay, there's a lot of imbalances in the markets, a lot of them. You're going to see a lot of formations like this, where there's a 50% candle, and then there's a big explosive move to the upside. And those explosive moves to the upside are not all institutional, okay? They could be retail, hedge funds, people who, are trading off of fundamental analysis or a test of a trend line or support and resistance, okay? So the reason why we are tracking every single institutional supply and demand zone is because we want to be able to determine when this happens in the market, whether it's an imbalance or whether it's a zone created by the institutions. Otherwise, when you look at this, unless you're actually there watching that candle formation be created, and you're in tune with watching the news and watching Twitter and looking at the data releases, you're not going to completely understand what caused this market to move up in such a fashion. Okay, and I don't know about you, but I'm not sitting at the computer 24/7 watching every single candle be created and taking notes as to what caused that candle to be created. Many times I am, and I make notes on why those candles were created, but I'm not 24/7 watching the markets. So how do I know if this was just an imbalance pushed to the upside or if it was an institutional demand zone? So the only way we know that is by tracking the supply and demand by the institutions, going back as far as we can in history and then tracking them. Okay, so let's say this was a supply zone created by institutions, doesn't matter how long ago, a year ago, 2 years ago, 5 years ago, or 10 years ago. It makes no difference how long ago that supply zone was created. But let's say it was just created 3 months ago. All right. Now, I'll tell you one thing. If this was a supply zone created 3 months ago, and a candle came through it like this, okay, and we have wicks like this, and it closes up there, this is institutional buying. This is institutional buying. Only the institutions have enough power to push through their own supply zones and cause price to go up. Okay? Sometimes what you'll see is, and we've gone through this before. Let's just draw a little candle like this. Sometimes you'll see this and a big candle like that right through. Okay? And it's just, it doesn't even look the same shape as all the other 50% candles on the chart. And we see a big tall wick right through, and then it comes right back down. And many times that will be because of a rate release. So let's say Euro comes out, releases some really good economic data, or anything that's very positive for the Euro. What's going to happen is big traders, institutional traders who are not in the loop, will come in and buy heavily, and everybody is buying at the same time. And this causes such a move to the upside that you'll get price traveling through an institutional zone and then straight right back down. Okay? All that buying, all that hype comes into the market, and then it just immediately dies down and comes back up underneath, and it gets contained below that zone. And we know that if we take a look at this wick on one time frame lower, so let's say this was the daily chart, and we go one time frame lower down to the H4 chart, okay? Because the way that we look at charts is 4 hour, daily, weekly, and then monthly. So if this is taking place on a daily chart, you take a look at that wick on the H4, and it's most likely going to be a wick as well. Okay? 9.5 times out of 10 when it's like this, it's a wick as well on the H4 chart. And that tells us that it was big emotional buying. A lot of people came into the markets because of the data release. They bought because they thought price was going to continue going higher, and all of a sudden the steam runs out, price comes back, and it gets contained under the supply zone. We don't consider this supply zone broken in situations like this. Okay? Only when we see a situation like this. Nice big move, closes, nice big move, closes, nice big move, closes. This is a structured approach through the supply zone. This is a well thought out, methodical move done by the institutions. Okay? They have determined that they are not going to use their supply zone to cause price to move lower because they want price to go higher. So when they do this like this, nice and methodical, nice closes right through, nice close, no big huge wicks, no emotional buying, then we know this is an institutional demand zone. And we draw that out, and that zone still remains on the chart until whatever day comes where that zone is taken out. Okay? Now, if we didn't have this supply zone here, okay, we've been tracking all the supply and demand from the institutions, and there was no supply zone here. But there was still a large move. Okay? If you have a move like this, big tall candles, big tall candles, big tall candles, no massive wicks, this is structured movement, and it's a big movement to the upside. This is not retail buying, okay? This is not emotional buying. So we can determine that this is a big imbalance of importance, okay? But it's one thing to classify this area as a zone, which is an area that removes an opposing zone from the institutions, and simply an imbalance. Now, I would still draw this out, as you've noticed, but I don't draw out every single imbalance that I see that looks like this. Okay? Only the ones that look important to me. And we'll go through real live examples to show you the difference. And it's going to take time for you to be able to distinguish why this area I should draw as an imbalance and why all the other ones you should ignore. But when you have a big movement like this and there's just no areas of supply, you know, typically what you're looking for is this. If on this chart here there's big moves like this, okay, and you know that's institutions were doing that, okay, but the move was so strong that they never paused, okay, there was no chance for a supply zone to get removed because the move down was so strong that they didn't even pause. So there was no supply, okay, and it didn't remove any other opposing areas. If there is a zone here, if there was a zone, a demand zone here, like this, then the supply would be up here, okay? Even though it got removed here, this area wasn't supply, this area wasn't supply because there's no 50% candles. So when there's a massive move going through an area where there is just nothing but a big, huge drop, this is the circumstances where I would draw this as an imbalance, okay? If this was a supply zone here, and then price dropped, so there was no supply here, but there was one supply here, and price came and hit it and dropped. Do you understand why I would not draw this as an imbalance? Okay? Because it didn't remove anything, and it's dropping from a supply zone. Okay, so you could still draw it as an imbalance, but you'd have to make sure that you understand the difference between a zone and an imbalance. An imbalance is just an imbalance. A big move to the upside that you've determined was created by institutions, but not of any importance because it wasn't this area that was used to remove an opposing institutional zone. When the institutions come in and they make a decision that they want to remove one of their own zones, that's a big move. That area, that core area where they are establishing a big position in order to remove an opposing zone, that's a big decision. Okay? They're removing that zone for a purpose because they don't have intentions to use it to cause price to go lower. Okay? And depending on how many positions they get filled there, they may just reverse it, fill in the rest of their orders before they take it off. Or they could just take it out and continue price to the upside depending on where along the storyline price is. Okay? So if we draw this as an imbalance, we have to understand that if price was to come down here, we couldn't just buy here and sell here. Okay? Because yes, it's an imbalance, but this move, this imbalance could have been just in order to get price up here to go lower. Okay? If this was a supply, they could have filled in their sell orders, ran out of steam, and then created an imbalance to push price up into that area of supply so they can fill in the rest of their sell orders and cause price to go down. Okay? So that's what's really key about understanding the difference between a supply zone and a supply imbalance, is to understand the whole purpose for that area being created. Okay? Is it being created to cause price to just move up to a supply zone so they can sell the heck out of it and cause it to drop? Or are they creating this area because they have intentions of removing their own supply because they want price to go higher? Remember, these are like doorways, right? These are doorways. And until these doorways get opened, we can't know whether it's going to go higher or lower. Okay? So that's the key thing to understand about a supply zone and a supply or demand imbalance. Okay, you guys get that concept? I think you guys do. Let me just stop for 1 second and read through some of your questions. Okay. George, trying to find a chart. Okay, so you're still looking for the chart, I guess. When do we look into the H forward? When do we look into the 4-hour demand and supply? Behringer, when do we look into the 4-hour demand or supply? Well, that all depends on what's taking place, because remember, there's always a storyline in play. Okay, you look at the monthly is telling you a story. You look at the weekly is telling you a story. You look at the daily, the same thing. The 4-hour, the same thing. So you'd only look at the 4-hour when it applies to what you need to do. Okay, but that's other lessons that we will get into, and we've already touched upon those topics, but we'll do classroom sessions on those as well. Right now, I just want to stay focused on just finding supply and demand, and the whole reason why we're finding the supply and demand, what they look like, the difference between a supply imbalance and a supply zone. Is that good, Behringer? I have a couple. How far are you scrolling back in time to start drawing supply and demand zones? As far as I possibly can. My analysis on all of my charts, all of my supply and demand zones, I started by going back as far as I could in the timeline. Okay? And let me tell you, many, many times what I'll do is I will open up a chart and I will go back in time and just restart, just start doing drawing of zones and trend lines again. Because the more I do this, the better I get at it, and the more knowledge I have, and the ability I have to spot the zones and the trend lines become better. And I'm not perfect. The analysis I did 3 months ago, it may not be as good as what I'm doing today. And I might have missed a zone or two, and it happens a lot. You know, it happens a lot. Like just yesterday, in preparation for today's class, I was doing some chart work, and I noticed some zones that I had missed. And it's so key to not miss any zones, because when you miss the zones, you miss the storyline. And so if you miss zones, if you miss drawing zones that took place 2 years ago on a 4-hour chart, you could miss a critical trade signal to get in short on the Kiwi, okay, or on oil, or on what's the latest one that I was looking at? On oil, on yeah, I was looking at this one here on the 4-hour chart. Look at oil continuing to drop. Okay. So I go back as far as I possibly can to find the zones, to keep track of every single supply and demand zone created by the institutions, because they may not be important for a day, a week, a month, 2 months, 5 months, a year, 2 years, 5 years. But eventually, one of those zones that you drew years ago, months ago, weeks ago, are going to come into play, and they're going to come into play at a very crucial moment. So let's say you're looking to get into a short position on oil, okay, and you're looking to get into it on a 4-hour chart. Well, you'd have to know where all the demand zones were for you to know where the supply zones were. Because if you know that the momentum is strong to the downside, and you want to jump in on a 4-hour zone, you have to know that this area here is demand, and this area took it out, and that's why price came right back up to it and then dropped. Okay, you have to know that this is demand to know that this is supply, and price came right back up to it and dropped. All right, if you don't keep track of the zones, when the time comes, you're not going to know what institutional zones are being taken out, and therefore you're not going to know which zones are valid, and you're not going to be able to determine where the signals are to go short. All right, so number 2, imbalances confuse me. How can you look at a zone and say for certain there is an imbalance? So I think I answered that question. Let me know if you understood. Let me just fast forward here. Thanks. Okay, yes, you did. Good. All right, good stuff. Jasper, retail traders who are selling. Yep. Sergey, hi Kev, wanted you to go over the Euro 4-hour recent zones. Okay, let's go. 4-hour recent zones. Recent zones that have been removed. There's just so much wicks that confuse me. How to draw the correct demand zone? Yeah, like these wicks here, right? Well, remember I told you retail coming into the market and causing big wicks to the upside, right? So you look at this big tall wick. Look at the 50% candles. This is what I do. When you look at a chart, what you want to look at is you want to see what's the average size of a 50% candle, okay? So you can go through all of them. That one, too big. That one, 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 that one. Okay, you get you start to get an idea by looking at all the 50% candles. Your mind starts to paint a picture in its head. I just look at a chart and I scan through it, and I'm like, okay, the average size is like that. In my mind, that's what gets put into my mind. The average size 50% candle is like that. So when I see something like this, immediately I know something took place there. Okay, and then you can look at the date, and then you look at your economic calendar and look at what took place around that time. This is what I typically do. If I'm not there at the charts to take note of the candle formation and to take note that that is retail buying, then what I'll do is I'll come back onto my charts, look and spot these areas. I'll go down one time frame to see what took place here, and then I'll look at the economic data to see what was taking place at this time and date. And so any big move going through zones like this that happen to look like that, I do not validate this as being the cause of that zone. So therefore, this is the zone here. Okay, and as you can see, we're getting the reaction from it now. And so here's a trend line right here. What 50% candle was responsible for removing that trend line? This one right here, which got broken here. Okay, but this is the 50% candle that existed. The next 50% candle broke right through it. But if you look at that 50% candle, you can see it's roughly the same size as most of the other ones. So that's not retail trading just breaking through a zone and not being significant. That is an important area. This area was broken on purpose to validate this area. Okay, so that anything that breaks this area is institutional demand. So this was the area that was institutional demand. Okay. Let me just fast forward and see if you have any comments regarding my explanation. Does that explain anything better to you? Does that make more sense? Let me know, Sergey. Hey, Kev, do any of you want to go on microphone and ask your questions? Because we can do that, and we can start hearing everybody's voices. I want to start making these classroom sessions more interactive, okay? More like a classroom. I want to hear your voices. I want to hear your interaction. We can even share your charts if you want to, okay? I can share the screen, your screen, so that you can show me what you're looking at. Makes sense? Okay. There's so many wicks. Yeah, the wicks can make things confusing. But don't worry too much about this right now. Just focus on drawing the zones, the ones that are really sticking out, okay? The ones that break opposing zones and become valid. This wasn't the zone because price did not consolidate away. So we look up to the next area, which is this area, okay? And so this area not only broke through a trend line, but it broke through this area. Why? This area wasn't demand because price came up, broke through it, and then price came right back down to that area. No consolidation away, so you look down to the next zone, and it's this one. So this area caused the opposing zone to get taken out, and also this trend line, so it's important. So when this area gets taken out, the area that caused the removal is important. When this area gets taken out, the area that caused its removal is important. Okay? Anybody want to chime in? Nobody. Everybody's so shy. Is everybody shy? Nobody wants to come up. Nobody wants to hear their voice. Hear their own voice. I mean, I won't make anybody look bad. Oh, you're at work. I understand, Marvin. Anybody else? You'll get a lot out of it. You'll be able to ask questions, and you know, we can have a good conversation. I'm sure it'll be helpful for everybody else, and I'm sure everybody else wants to hear who the other members are. Okay, so let's go through the rest of your questions. Want to go over the euro, okay. So the zone is taken out only when price close over the zone. Not necessarily when price closes over the zone, Marvin, because you could have, well, let me just show you a real chart example. You see how this didn't close below this, okay? But if you look at this candle, it's the average size of the rest of the 50% candles. So that means that this was institutions breaking through this area, okay? Look at the difference between this candle that didn't close below the zone and this candle that didn't close below the zone. You see the difference? You see the difference in size? This one's twice the size of this one. And usually what really makes them stick out is a lot of times you'll see massive candle, like that. Most of the times you'll see that, but not all the time. So this didn't close above, but you could tell because of the size of it, it was emotional retail buying. This, because it's the average size of everything else, you could tell that that was intentional to break through this area. Okay, I hope that explains, Marvin. Let me fast forward to your comments to see if you have. Does that make sense, Marvin? You understand that? I'll wait for your response. Let's see. Is this recorded? Yes, it's recorded. I need to watch this a number of times. Yeah. Every classroom session we're going to do will be recorded. Every time I do a webinar, it's going to be recorded because many of the members, they're from all over the world and not everybody can be here. The vast majority of you are not here. So I have to make this available for everybody else. Okay. How would zone when the pause candle has spike up before the next bull candle? How would you draw the zone? Like this. Like how I did here. I just ignore this. Whatever's the emotional buying, I ignore it. And because this fits within this, because this candle fits within all this here, I just ignore it. I just ignore the top of that because this is pretty much the basing that was happening before the explosive move to the upside. So I just ignore this and just draw the base this way. But you'll see it. It'll be different. There'll be different scenarios. I mean, let me try to see if I can find the last time that happened. 222. Let me see. Right here. Okay. Right here too. This big candle here. So if this moves to the upside, the base will be like that. Okay. And I just ignore this whole candle. Big move to the upside. Because as you can see, it's not the average size of the rest of the 50% candles here. And I was watching this and I knew that this was news related. I was here live to watch this happen. Okay. Okay, yes you did. What are the percentages on the right top corner? These percentages just basically tell me how far up or down we are between zones. That's all. It keeps track of, like for instance, on the monthly chart, here's supply and here's demand, and we are about 42% between the two. If price was up here, we'd be at 100%. If price was down here, I'd be at a 0%. I use these figures to help me with tracking trades, tracking the performance of specific entries, okay, based on specific patterns and chart formations and all that stuff. Getting stats on, was it a good idea to buy when we were 50% stuck in the middle of these two zones? Or was it better to buy down here, depending on which zone was in control and all sorts of other stuff, okay? Okay, so makes sense, thanks. Okay, you answered my question about the wick, which was when price breaks through a supply zone but doesn't close above it and then retraces. Do you keep the original zone in place? However, sometimes it only slightly breaks it and retraces. Does that make a difference? If it slightly breaks it, but that candle formation, the 50% candle formation, is an average size, if it breaks it by 1 pip, it means that the zone's broken, Jasper. Okay, you'll see that a lot of times. A zone, a little 50% candle will come up, right up by 1 pip, and then drop, and then price will drop, and it's broken. 1 pip is broken. You know how many times I use this tool, this crosshair tool, and I'll go to the top of that candle and I'll look at the price at the tip of that wick, and then I'll look at the price at the tip of that 50% candle, and if it's over by 1 pip, that's it, it's broken. If that candle formation, that 50% candle looks average size, that zone is broken and it's to be recognized as broken. Okay, 1 pip, that's it. That's all it needs. Hi Kev, I'm in this trade. Zone, would you? Hi Kev, I'm in this trade. Oh, which trade are you in, Marvin? The 4-hour zone here to go long? Is that the one you're talking about? Yeah. Okay. It could work out. Weekly demand is still in control. And looking at the market dynamics, it looks like we're going to get that bigger rally to the upside. What the institutional trade signal for me is a daily zone. Okay. Because I would need a daily force to confirm that this weekly area of demand is not going to be taken out. Getting in here is assuming that on the daily chart, the institutions are going to break this trend line. So you're making a big assumption here, and it can very well work out. Okay, I was speaking to another member about them wanting to short the US Swiss franc. Okay, this can very much work out, and you can see so far it's working out. Especially once this candle here, if it closes above this basing here, then the odds are in your favor that we're going to get the bigger move, right? Because momentum will be coming into the market. It won't be paused anymore. Momentum will be coming into the market, which will be a good sign showing that price wants to continue higher. But you got to understand that taking this trade, you're making an assumption that the institutions want to break this descending trend line on the daily and create an explosive move to the upside. And I think I think the risk reward on this trade is not too bad. I would be putting, let's see here. So if you have your stop loss here and you got your entry here, 2 to 1 would be here, just above this high, okay? And if you look at the charts, this is supply, this is not supply. The next supply zone is up here. So if we get a candle closing on the 4-hour above this basing here, okay? If you get a candle closing above here, above the basing, that means momentum is in the market, and we know that there's really nothing to stop price until this area here on the 4-hour. So having a bulletproof here wouldn't be a bad idea. But because this is inherently a high risk trade, because you're making an assumption that price is going to go higher, because again, remember, price is sitting at a descending trend line on the daily chart. What happens when price hits a descending trend line? Retail traders come in and sell. So you're making an assumption that the institutions are going to come in and buy this against the retail traders selling. And I think this is I think it's a good assumption to make. It doesn't have the risk reward that I would personally like to see for me to put my money in the markets on this trade, but it could very much work out. I think if I had to place odds on this working out, I'd say the odds of this trade working out are probably 60%. Okay? Why? Because of this. Because even though there's good odds that price is going to move up like this based on a weekly zone being hit, based on the trend line being hit and all this formation here, based on looking at the dollar, at the pound, at the Kiwi, at the Aussie, and looking at what those charts are doing, even though there is a good chance of this move to the upside, this move to the upside could still happen and price come down here and go like this and then like that. And on the daily, we'd have basing and then the big move. So that formation would still take place on the daily, but on the 4-hour, this zone would be taken out. Okay? This may work this time, and the next time you see a scenario like this, when you've done this long enough, you'll start to recognize these scenarios playing out in different circumstances, but you'll recognize that it's pretty much similar scenarios. And if you take this trade and it works out, then you're going to start programming your mind to think that, wow, I can always get in early off of 4-hour zones and get very big risk to reward, because if price is most likely going to move up on the daily, the next daily supply zone that's going to stop price is up here. I can get in here and ride price all the way up to that daily area of supply. You're going to start programming your mind to think this way, and it may work out today, but next time it'll drop through the zone and consolidate before a move to the upside. And on the daily, you'll see it as consolidation before the break and move to the upside. That's why for me, I know based on my experience of trading these areas many times before, and sometimes they work and sometimes they don't, I've been able to gather that it's not worth the risk for me to always trade these scenarios, because I'm looking to make more winning trades than losing trades. That's what I'm looking to do. And I'm looking to do that because I don't want to get emotionally involved when I'm constantly losing because I'm risking on trades like this. Okay? A good example of that is the Kiwi. All right? Kiwi 4-hour chart. Now, I had mentioned in a previous report that price was hitting a weekly area of demand. So the force of price was up. And I also mentioned that when I was examining the CFTC report and the positions by the institutions, I was able to determine that short positions were so aggressive that based on previous history of the institutional positions, every time the institutions were so heavily short, they did the exact same thing, which was to take profits on their short positions, which caused price to move to the upside. Okay? So where was that move going to happen from? Okay, where was it going to happen from? So we saw the institutions create some supply, price came down, came inches within hitting it. I think there was a nested daily area supply, which worked. It was an institutional trade signal to go short. Price came down, tested this weekly area of demand here, and look what happened. It came up, but then what happened? It came even lower. Okay, and so if you look at the 4-hour chart, that first test, let's see if I can find it. That first test of the weekly area of supply was right here. So if you were under the assumption, well, hey, if I can find a 4-hour zone to get in long and ride this rate to the upside, because I know the institutions are going to take profits on their shorts, which is going to cause price to go up, and we're hitting a weekly area of demand, which means price can most likely head up higher from here. If you're looking for entry on the 4-hour zone, 4-hour zone is here, this could have worked, but over here it didn't work, right? And it broke through, and there's reasons why it didn't work. But on this zone, it worked. Okay, we're in weekly area of demand, and I drew this out. And as price was dropping to it, I was looking at it, and I said, you know what? There's a very good chance price is going to react from here and head higher like this. Very good chance. Why? Because I was looking at the other markets. When price hit the weekly zone here, the other markets weren't showing signs that they wanted to reverse. But when price came down here and broke the momentum to the upside, I was looking at the other markets, and the other markets were showing signs that price wanted to reverse. But it wasn't the right scenario to risk money on a trade like this. If we were reacting from higher time frame areas of supply and demand that were going to be used to facilitate a bigger trend in the direction that the higher time frame trends are pushing price, I would have definitely gotten here. 100% I would have gotten here. But under this scenario, it wasn't a good time. But it worked. Okay? It worked. Look, imagine getting in here. Look how well it worked. We're up here now. Okay? There, bulletproof, look how great of a move it was, right? And then the secondary entry was right here. Okay? But these were risky trades, and the way I trade, I don't take certain risks. Okay? Because price is reversing to the upside. We were at a descending trend line, so you have to make assumptions that it's going to work out. You have to assume what's going to take place. And in trading, thinking that you know what's going to take place is different than knowing what's going to take place. Okay? And this is a scenario where price was hitting a trend line, and what we do know is that it's hitting a trend line, and that we do know that force is to the downside. And we know that it was reacting off of this area of supply. Remember this area of supply? Right here? It worked for a little bit. Some of you took trades. I told you I wasn't going to take it because weekly demand was in control and the force of price was to the upside. Well, that's why, because the drop to the downside is limited. But you don't know how far it's going to be because supply is in control, trend lines in control, a lot of things are in control. So to get into a trade on a 4-hour chart, you have to assume you know what's going to take place. There's times when you can make those assumptions, and there's times where you really shouldn't. And this was a time where you really shouldn't. And did it work out? Yes, it did. Okay. So let's get back to your questions. Oops, didn't mean to do that. There you go. Okay. Let me get back to your questions. I've noticed on your charts that you will draw the new demand zone even if it hasn't consolidated above the supply zone, which confuses me. But now I've just seen with your analysis on your US dollar why you do that. Now you see why I draw a zone before it consolidates away. Sometimes, just for my own purposes, you know, an opposing zone gets taken out, and there's a zone here, and a new area is being created, and I'll draw the zone in even before this candle closes because it could still come down, right? I'll draw it just to keep track and so that I don't forget to draw that zone. Okay, as I'm doing my analysis, I spot it and I draw it. Sometimes I don't. Okay, sometimes what I'll do is I'll just cut this zone off and I'll leave it on my charts and I'll wait for this candle to form and close, and then I'll come back and I'll draw that zone. Okay, Jasper. The last demand box, why not a bit further back at the 5 November 50% candle, November 5th 50% candle? This one here? Why not this candle here? Because where was the basing before this zone got taken out? The basing was here before this zone got taken out. Okay? If this was not a big overextended 50% candle, but a regular sized candle, and the bottom of the wick incorporated these, then I would have to draw this one here, because that means that basing was responsible for actually removing the zone, and I don't want to find that. I want to find a basing candle that existed before the opposing zone was removed. Before the opposing zone was removed. That is demand. If there's a zone like this, a supply zone, and there's a little wick like this, and that wick of the 50% basing removed the actual zone, and there is other 50% candles right next to it, and then a drop, and then a 50% candle here, I cannot draw these 50% candles as being the basing before the zone was removed, because this wick that is part of the basing was responsible for removing. So only under that circumstance would I draw the zone below it. Does that make sense, sir? 5 more candles across. No, a bit further before the big. Oh, this one down here? This is a zone because it was the original spot that caused the move to the upside that broke this trend line. That's why. That's the only reason why it's a zone. So it's a weak zone because it didn't cause the removal of an opposing zone. It just was the original spot that caused a move to the upside that eventually broke this trend line here. Make sense? Let's go on to the next question because we're coming just over an hour already. Wow, this session went fast. Okay. I have a question to go over on Aussie US dollar. What's the question, Sergey, on the Aussie US dollar? Let's go to the Aussie US dollar. I'll wait for your question. While you're writing your question on the Aussie US dollar, I'll read through the other questions.
This is just fascinating because I never knew about supply imbalance, and that makes complete sense. I'm looking back at my charts, and wow, thank you. I'm loving this. Great stuff, Kevin. Yeah, this is powerful stuff. This is how, I mean, in my opinion, this is the only way to analyze the markets, because you can apply the same reasoning and the same technical analysis to any market conditions. Any market conditions. 10 years from now, you'll be able to apply the same reasoning and the same zones and how to draw the trend lines and how to draw the zones and how to analyze the markets the exact same way. Doesn't matter what happens in the markets. You'll always be able to do correct analysis. If you're doing the correct analysis, you'll always be able to apply these concepts and principles to any market circumstance, any market conditions, and be able to time reversals in the markets before anybody else. Is it any preferred session to enter a trade when zone get filled? Any preferred session to enter a trade when zone get filled? No, doesn't matter what session. If a zone is legit and it fits within the dynamics and the storyline of what's taking place on the higher time frames, and it's a trade signal, it doesn't matter when it gets filled. Makes no difference. Is preferred session. Okay. Also, what is the difference in the breaking of zones, whether it's consolidated or not? Okay. Whether it's consolidated or not, because if you have a supply zone here and you have basing here, and price comes right back up, right up through that zone, if it immediately comes right back down, then that means there wasn't such a big imbalance here where the institutions want to fill in orders. They filled in demand and it came right back down. And the only people that are going to push it right back down are institutions. Okay, so if they pushed it here just to fill in sell orders to push it right back down, then that means this is not a good area to buy. If they push it up here, but they didn't fill in so many sell orders to push it right back down, but instead it consolidated, okay, which means they were either offloading a little bit of those longs or buying a little bit of their shorts, but more importantly, retail traders that were getting in late find out that, oh, this is not going to go any higher, and then they start taking profits, and then all of a sudden it starts collapsing, and then all their longs, they go into a drawdown, and then they sell their long positions for a loss, and then it comes down, and then the institutions get back into their long positions. That's why we want to see consolidate away. It's basically to tell us that this was a zone where the institutions are interested in filling more of their orders to go in. If they push it up and they push it right back down, then that means that area is not an area that they more likely than not want to start accumulating a long position. Okay? Sometimes price comes in the zone, consolidates within it for a while during Asia time before moving, but not during New York or London. The reaction is fast. Yeah, that's true. That does happen. Depending on the currency pair, depending on what session, depending on the agenda of the institutions. You'll notice that a lot of times what the institutions will do is they'll focus on certain currency pairs. So they'll be buying heavily the euro, or like, what was it yesterday? The Kiwi, right? Look, what were they focusing on the last few days? The Kiwi. Do we see massive moves like that on the euro? No. On the pound, we got a little bit. So the pound and Kiwi were two, and I think the Aussie too. So pound, Aussie, Kiwi were the movers. Okay, euro, dollar, not so much so. US, CAD. So they go in phases. They focus on certain currency pairs, they do their moves, and remember, all the markets are pretty much aligned with each other. Okay, you'll start to see that. You'll start to see how they're all aligned with each other. And the great thing is once they show their hands in a couple currency pairs, then it's pretty much foretelling what's going to take place with the other ones, as long as you understand where in the storyline each of them are. But these are like a lot more advanced concepts that you'll only understand once you've been doing this for some time, okay? Right, I need to wait for confirmation in the future. Marvin, yeah, about your euro. Yeah, this could work out, Marvin. It's just that in time, if you want to be more consistent with your trading and with your results, taking risky trades like if you want to take a trade like this, take it with less risk. So if you're usually risking 1% of your portfolio, risk 0.5% or 1/4%. Okay, because these 1/4%, I mean, if this move happens, you could make a really hefty return on that 1/4% risk, you know. And if you're okay with losing 1/4% on risky trades, that's great. But my advice to you is wait until you establish yourself a little bit more with these concepts. Wait until you have more experience, because you'll be better able to determine high risk scenarios to trade and high risk scenarios to not to trade. Okay, you'll be better equipped. Although, you know, this is a pretty decent one. If I had to trade a high risk scenario, this would probably be one of them. Okay, just like the Kiwi dollar buying down here on the 4-hour. If I had to trade high risk scenarios, I would have bought down there. And as you can see on the Kiwi dollar, it worked out just perfectly, and a really nice return could have been made on that. Daily descending trend line is broken, isn't it? On the here, nope. Here's a daily descending trend line right here. The last candle we had was this one right here, and it was touching. The candle right now being formed is touching right here. For it to be closed, for it to be broken, there has to be one candle closing on the opposite side of that trend line that neither the wick or the body is touching the trend line. Until that happens, that trend line is not officially broken. So the trend line isn't broken yet. Hello, can you look at the Aussie? On the weekly, you found 2 supply zones that met and you canceled one of them. Do you cancel one of them? Any importance if the first one is broken? Okay, let's go to Aussie weekly really quickly. Canceled one of them. Not quite sure which one you're talking about. See, this is why it's good to be able to do screen sharing. You wanna, oh, you've already left, Cosmin. Do you cancel one of them? See, I'm not quite sure what you're talking about. So what we need to do for future classroom sessions, I highly recommend that we connect to each other's computers, get a chance for you to chat, and then you can screen share your screen and you can show me exactly on your charts what you're talking about. It'll save us a lot of time and confusion. All right, my friend. So I don't know what you're talking about, what zones you're speaking of. You found 2 supply zones. Yeah, I'm not quite sure what you're talking about on the weekly chart. Sorry. Okay, let's get to the rest of your questions and then we'll end this session. I wanted to go on the mic. Okay, you want to go on the mic? Okay, I'm gonna unmute you, Sergey. All right. There. You there? Sergey? Oh, I unmuted you. There, you're unmuted.
Hello, everyone.
Hey, how are you?
Good, yourself?
I'm doing very well. Sergey, that's how you pronounce it, right?
Serge.
Serge, okay, sorry.
Yeah.
Okay, so what's your question, buddy?
All right, so I have a question on Aussie dollar.
Okay.
It's going to be daily chart.
Yeah.
Okay, and the recent one would be the one that removed the trend line. You had it right there. It would be 72.101, 71.88, 828. So we have that one. Yep. We have the one candle that broke, had the wick, and then another one formed a 50% candle as well. And then we had a long body candle. We closed above it. And then the candle on 1107, they came back down and it touched the wick, but not the body.
Right.
Would it still be considered as? That's why I'm confused a little bit. It's like one time it works, the other time it doesn't work.
Okay, great question. So let me tell you something here, okay? So first of all, let's take a look at what took place at that wick here. Okay, let's take a look at this wick here on the daily. And you can see that there was a nice 50% candle, and then you see this big tall wick up here?
Yes.
And you see the candle formation, not normal. So we know that that big extension to the upside is telling us that there was some emotional buying there, okay?
Okay.
But This is not the reason why I'm drawing this as a zone, because it removed this area, because that would be questionable whether this zone, this wick, is considered to be responsible for removing it, or because of the 4-hour wick, this is emotional buying and therefore it's not considered to be removing this zone. The reason why I've drawn this out here is because it was responsible for removing the weekly trend line. Okay, so we have the weekly trend line here, and I've drawn out this weekly trend line on the daily chart, and I want to take note of whatever zone is responsible for removing that, because it's going to be an important zone. Okay, so here's the thing. Whenever a zone takes out a trend line, if price comes back, and let's say this trend line came right back into it like this and touched that zone, I would still have that area drawn out. Okay? Not because it removed an opposing zone, but only because this area was still responsible for removing this trend line. Regardless of if price came right back down and tested it, it still was the area responsible for removing that trend line. Okay?
Okay, so question, it doesn't really have to be a consolidation away when the zone removes a trend line.
Yeah, so let's
like if it assume it would have removed an opposing zone, not a trend line, then it would not consider as a valid
if it removed yeah, so let's say that the only reason why I was drawing this zone here was because it took out this area here.
Yeah.
Okay. Let's say this candle with this tall wick did not exist. Okay, that's important to know.
Yeah, I understand about that candle. It's too big of a wick. I understand that doesn't qualify. My concern is about the second candle from the recent candle.
Yeah, this one here.
Right here.
Yeah. So let me draw you something. Let me draw you something just to explain. So let's say this is basing.
Mm-hmm.
And that's the candle formation, and we have another candle like this, and it removed a 50% a supply zone like this.
Okay.
Based on how this candle looks here, I draw the zone like this.
Okay.
From the top of the body to the bottom. Okay. Let's say this is not a doji single candle where I would use the top and the bottom of the wick. It's a nicely formed 50% candle with the body a decent size. Okay, but 50% less than the total size. If the wick came down like this but did not touch that body,
okay,
I would not say that that zone was hit.
Okay,
I would say there's consolidation based on how you're supposed to draw the zone. But if this happened and did that and just touched it, that's it. This is no longer a zone.
Yes, yeah, that was my question.
Yeah,
because that looked like even though it looks like a 50% candle, but the wick came down and came back up.
Yeah.
But because, like you said, the body is not like a doji, it's more like a body 50% candle. That's why it wouldn't drop from wick to wick.
Right. Now watch this. So now this is the doji, right? And you have a big candle like this. And this removed supply, and there's no other 50% candles here. Okay, price came up, created a doji, and went up. We know that when we have candles like that, we have to use the top to the bottom of the wick, period. That's the rule, and you have to do that. So
yeah, I know that.
Yeah, so if price comes and touches the top of the wick like that, it's no longer a zone.
Yes.
Okay, no longer a zone. So you have to look at it as each individual circumstance and see what's the legitimate way to draw that zone and whether that wick touched it. And if this was a legitimate way and it touched it, then it's not a zone.
Okay, now let's go then to 4 hour on the same Aussie dollar. I think there's a similar scenario here that over there, and they removed the zone, the supply zone on 1102. Yes, there.
Yeah. Okay, so
like,
big mess, right?
Yeah, which zone would be? Yeah, how do you would draw it that correctly?
Well, this is very difficult. I mean, look at this, and it's a complete disaster, right? So we had price go up, it consolidated, it moved up, it took it out, but then the next one came back and touched it. So I'm drawing this because it's significant. Something happened here. A lot of garbage happened here. This was a crazy red candle, this was a crazy green candle, and the next one was crazy as it came back down. I would not take a trade here. Definitely would not take a trade here. And whether or not this is a legitimate zone, it's hard to determine because of so much confusion happening here. I'm just drawing this out because I want to see later on if price takes this out, whether there's a legitimate zone there or not.
Same
Okay?
here. I'm just trying to teach my eyes to read how to draw these zones that way.
But I would not draw this in my textbook and say this is a legitimate zone. I would not do that. I'm only drawing it for my own purposes so I can see whether or not this circumstance, this zone was legitimate or not.
Okay, Kev, then let's go then. You see how was a rally base and then drop, and how you drew the zone here to the top of that wick. Yeah, right there, the supply zone.
Here?
And yes. Since there's a 50% candle in between, like the small one with the small body.
Yep.
Like in other scenarios, I see you drawing them to the top of that
just
candle,
to the top of that.
Yeah, just there, and it would be like cutting through that wick. But in this scenario, you had it included.
You know, it's extremely difficult to explain to you every little detail of why. I've just been able to train my eyes to know when I should draw it and when I shouldn't. And I know to you, you probably are like very confused because you see sometimes I do and sometimes I don't, right?
Yes,
okay.
Yeah.
But let's do this. Let's give you an example. Let's go back to the 4 hour. I just instinctively drew it like that just by looking at it. Okay. So, but let me draw a vertical line.
That's what I want to do instinctively.
Let me draw a vertical line. So that vertical line that I drew through this area here is here. Okay? You see that?
Yes.
Okay.
I see it now. You went a time frame lower.
Okay, yeah. I went one time frame lower to the 1 hour. Now, what is the rule when you see big tall wicks that just look out of normal? You look at one time frame lower to see if what?
If there's a wick or there's a bodies formation.
So what's here on the one time frame lower?
There's a
Is it a big wick or is there body? Is there body formations or
body formations?
Because if this here looked like this, okay, candle, candle, and then candle. If this looked like this, I wouldn't have drawn the zone at the top of that wick. I would have only drawn it over here.
That answered my question.
Yeah, but because of this beautiful bodies that are in that tall wick, because there's bodies here on one time frame lower, I know I have to draw that area.
I got it. So yeah, that answers my question.
Yeah, so you have to go through this process every time you see a weird formation like this. I've done this many times. Now I can just look at this and I can already spot that it's going to be like that without me even having to look at 1 hour chart. Most of the times I have to, but there are certain times when I just realize that it's not going to be like that.
Great. Okay. Yeah, that absolutely makes sense for me. I got it now.
Good stuff, my man. All right, so I'm going to wrap this up because it's been 1 hour and 25 minutes. Was this a good session for everybody? I hope it was helpful.
Yes, great session. Thank you so much for your teaching. You're doing
no problem. Thanks, I appreciate that, Serge. So we're gonna do more sessions. We've got trend lines to cover. We've got forces to cover, momentums, momentum shifts, all that other stuff. We're gonna be doing classroom sessions on it. So if you guys have any questions regarding those, log them into your logbook so that when we do have class, you can join and do like Serge. You can join me and you can I can unmute your microphone and we can have a conversation. All right, Serge, enjoy your day. And I'll be uploading these sessions. So let me show you really quickly to do. Okay, Serge, I've unmuted you for now. So if you look on the website, what I'm going to do, so I've realized that I got to make some changes here. With the trading video library, how I've had it set up is I've incorporated the level 1 and 2, level 1, 2, and 3. What I'm going to be doing is I'm going to be separating all the videos so that you have a good understanding of what is level 1 material. So when you click on level 1, you're going to see only the videos and lessons that pertain to level 1. And if you want to access level 2 information, you will click on level 2. And so when you go into level 2, supply and demand, I am going to take level 1 lessons and remove them from level 2 and put them into level 1. So everybody who has level 2 access, you're basically going to be able to access level 1 material through this menu. Okay, I want to be very clear on that. Otherwise, what's going to happen is when you eventually get to level 3, I don't want level 3 to have level 1, level 2, and level 3 lessons there, because it's just going to be too cluttered. So I'm going to structure everything so that if you want to access level 1 stuff, you click on level 1. You want to access level 2 stuff, you go to level 2. Okay, and from the main screen, I have this here, classroom sessions. So basically, I'm going to be creating the pages under classroom sessions to look like the trading video library. Okay, you'll have level 1, level 2, level 3. You'll click on it, and if you want classroom sessions for institutional supply and demand, you'll click on that and it'll open up and you'll have the classroom sessions there with a brief description on what it is that we covered, what we spoke about, what currency pairs we discussed, and so forth. So everything will be nicely organized through the main menu. Okay, so give me some time. I'm going to be doing some work on that today, and that's pretty much it, ladies and gents. So I'll let you guys go and I'll get back to things. And thanks, I appreciate that. I appreciate all your support. Keep up the hard work, and until the next classroom session, I'll be releasing that soon. Just going to get myself organized on what it is that we're going to do next, and then I'll send out emails for the next classroom. Okay, that's it for now. Enjoy your day, guys, and we'll talk to you soon. Take care.